So with the higher accumulation, also given climate change of natural disasters, the question, is it getting riskier or is it too risky to invest in cat bonds? My answer would be no. And the main reason for that is, if we look at the past, the average of the last 20 years, the average loss from cat bonds was 0.8% just. And this includes periods like, in 2005 with Hurricane Harvey, 2017 with Katrina, Irma, Maria. Even in those years, in 2005 the losses were 2%, in 2017 losses were 4%. So I think putting things in perspective, we are not denying climate change, it's happening, but there are some subtle elements in there that actually mean that there is not really an accumulation of potential losses from cat bonds. And we think, the asset class itself still makes a lot of sense. You're basically generating high yield returns with a third of the volatility, with a fourth of the drawdown. And ultimately, you're generating a Sharpe ratio which is 3 times higher than what you see for high-yield bonds. And at the same time, it's a great diversifier. You have, a correlation of pretty much zero relative to pretty much any other traditional asset class. So it's great, even, specifically in these times where people are looking for diversification and cannot get it. Cat bonds can give you that. And I think when you also compare, risk compensation to potential losses, you are currently getting a credit spread of 700 basis points or a yield of about 9%. If you compare the two average losses, as I mentioned, of 0.8%, I think that's a great risk return profile that you are potentially getting from cat bonds. So I think, and a lot of institutional investors would share that view because, we see them as our investors. They very much subscribe to that notion that, on a risk return perspective, diversification, and also on top of that, you have very little duration, 0.3 years modified duration, so very little interest rate risk. We think it's a great asset class to be invested in.